All right, let's go ahead and kick it off. Get out of here. My name is Shane. I run the events and investor relations over at 10 Capital Network. Thank you for joining us today. Our event today is about should you be considering crowdfunding, and we have Krishan Arora of Arora Project with us to discuss the topic. So please feel free during the session to drop your questions in the chat box, and we'll have Hall fish them out. So Hall, with that, you want to take it?
Great. Thanks, Shane. And thank you, Krishan, for joining us today. Can you tell us a little bit about yourself and your company, just so the audience has some background?
Yeah, and hello everyone. Thanks for jumping in here. My name is Krishan Arora, and I run an organization called the Arora Project. And our goal is simple: to raise capital for founders, up to $5 million on a Reg CF, or up to 75 million on a Reg A Plus offering, in the most founder-friendly way possible. And the reason why we use the term founder-friendly is because we believe raising capital through accredited and unaccredited investors in the private markets, so fundraising in the private markets through in the online world, is a much faster, better way than raising capital in other formats that you may have access to. That's what we do. We've raised a little over $110 million doing what we do over the past couple of years, and this is the world we live in, working with awesome founders, raising large rounds of capital for them, and that's why we exist.
Great. And so how have you seen crowdfunding evolve over the last 12 months? What have you seen happen?
Yeah, this is great. So this requires me to set some context on what crowdfunding actually is. And I don't really even necessarily like the nomenclature of crowdfunding, because what we're doing far supersedes the word crowdfunding and sort of the origins of that word. We're raising capital from investors in the private online markets. And that one interpretation of that is definitely crowdfunding, but that's the mainstream understanding. So how has this market, or this world of raising capital in the private online markets, evolved over the past 12 months? It's evolved drastically. So setting the stage, starting January 1st, 2017, the SEC launched Title III reform of the Jobs Act. And what Title III reform of the Jobs Act allowed businesses to do is to raise up to $1,070,000 from unaccredited investors. And for most companies, that's social media followers, email list subscribers, users of your product or service, friends or family, things like that. You could raise up to $1,070,000 with the minimum as low as $100. Right? So people could just take out their payment methods, and for the $100 buy equity in your company, and you could raise up to $1 million that way. So, 1,000 people putting $1,000 each, or 2,000 people putting $50 each, whatever it may be, you could raise capital through that route. That's where this world started, January 1st, 2017, up until March 15th, 2021. So over 4 years, the industry drastically grew from 17 million raised in 2017 to 50 million raised in 2018 to 100 million raised in 2019 to 250 million raised in 2020, and this year it's going to be over $500 million. So it's 20x in 4 years, the industry, which is crazy growth for any new vertical that's launched of fundraising. The biggest impact, to Hall's question, of what's happened over the past 12 months is March 15th of 2021, the SEC increased that $1,070,000 cap to $5 million, which made it a lot more palatable for some of the businesses looking to raise more capital, and the ability to implement SPVs, or one line item on the cap table, was also allowed starting March 15th, 2021. So that just made it much more venture friendly, and that was the biggest update in our space over the past 12 months.
That's great. So what companies do well on crowdfunding? What have you seen out there that's been quite successful?
Great question. We're really industry agnostic. We've raised millions of dollars for breweries, CPG companies, food tech companies, agricultural technology companies, fashion companies. But in my opinion, the sweet spot, this is not saying companies out of this industry won't do well, because we clearly have the case studies at our website at aroraproject.co. You can check out all the case studies that we've done. But the sweet spot, in my opinion, is B2C SaaS companies with existing users as a base to go to. So if you're a mobile app or a web app company that has 10, 20, 30, 40K users, and you have, 10, 20, 30K in MRR, that is the sweet spot for equity crowdfunding, because investors become users and users become investors. It's really easy for the investors to check out your platform because they can simply just download the app or check out the website. SaaS companies get very high multiples upon an exit, and it's really easy for them to become users as well. So in the B2B or B2C SaaS space, we've seen that be sort of the sweet spot.
What's the key to running a successful crowdfunding campaign? What should the issuer do to make that successful?
Great question. So the preparation actually begins 4 to 6 weeks before you go live. So I'll walk you through some of the compliance related matters that are needed, that are agnostic of the investor acquisition funnel and then the investor acquisition funnel itself. So regardless of which platform you work with, there's a few different platforms you can pick. The two biggest ones being Republic and WeFunder. They're by far the market leaders in this space of raising capital in the online private markets. Let's say you decide to raise a round on Republic, you're going, or WeFunder, as I mentioned. You're going to need to file a form called the Form C, which is some compliance-related paperwork that you have to do with FINRA and the SEC. You also have to do a financial audit of the company if you want to raise the full 5 million. So there's a bunch of compliance stuff that you have to do, which you need to do for any fundraising anyway. You have to have your books or your financial books in order. So after you've done that, usually takes about 4 to 6 weeks, depending on the health of your company. Then you can start simultaneously focusing on your marketing campaign. So you have to create collateral on digital ad campaigns, you have to create email campaigns, you have to create a brand awareness campaign. You have to let people know that you're fundraising. So over the course of the 4 to 6 weeks that you're preparing the compliance angle of fundraising, simultaneously, you have to start creating email drip campaigns to your existing customers, existing friends or family. If you're brand new to this and you only need to raise a couple of $100,000, I would encourage every founder to simply create an Excel sheet. Like, hey, mom, dad, uncle, sister, brother, college roommate, community members, users, put them all in an Excel sheet. And with the new update on March 15th, you can do what's called the Test the Waters campaign, where you can inquire how much people are going to invest in your campaign before doing the live fundraise. That also wasn't allowed pre-March 15th. So now with that done, simply create an Excel sheet with a Google form and send that Google form to all of your users. Put it up on your website, put it up on your social media, put it to friends and family, and ask them, hey, I'm fundraising at a $5 million, $10 million, $20 million valuation at a $100 minimum. Can I count on you to invest? A, yes, and then B, how much? Once you have that Excel sheet and you have a baseline of what your existing community can invest, subtract 30%. That's the real number of what you can actually expect your friends and family to contribute. Like, that should be step number 1. Then step number 2 is a much more deeper investor acquisition funnel that a team like ours could probably help you with, because we have over 75 offerings live right now. We're raising millions of dollars a month for high growth businesses. But to break down the successful marketing funnel would take me a whole couple of hour sessions. But you start with assessing your existing community, how much capital your friends and family and people that believe in you, your company, your users can do. From there, set up a much larger funnel to acquire other investors on the platforms as well.
Great. And how long do most campaigns run on these crowdfunding portals?
Yeah, great question. At the prep phase, we've usually seen last 4 to 6 weeks, because you're going to need to create the campaign page, create the campaign video, create your pitch deck, record a pitch of you going over your pitch deck, do the Form C filing, do the reviewed or audited financials, depending on how much you want to raise. So all that is the prep phase. Usually takes about 4 weeks, but you can get it done in a month, which is a quick turnaround time. Then on average, fundraisers, in our opinion, if you're trying to raise a couple of $1 million, last anywhere between 3 to 6 months. Some bleed a little bit longer, but 3 to 6 months is the sweet spot if you come in with a strategic plan. Now, we've been able to raise $2 million in under 2 weeks. So it really depends on how big the community is that you're bringing to the table. If you have 1 million users on your app and you just want to give your shareholder, your users, a stake in your company, and the beauty of raising capital through the private online markets is you're not giving up a board seat. These are non-board seat holding investors, which is huge. And 2, you could raise at a much more realistic valuation. Because in my opinion, I'm definitely pro venture capital, but at an early stage, without too much traction and revenue, I think there's two polar opposite factors at play. The venture capitalists or the angel syndicates want more equity and more board control, and you as a founder want to give up less equity and less board control. So from day one, those are two completely polar opposite factors at play. In the private online market space, the crowdfunding space that we deal with, these investors are coming in for a couple of $100 each, couple of $1,000s each. For most of them, they're not getting board seats. And if you were going to raise at an 11 or $12 million valuation in the VC world, realistically, you could raise at a 15 or $16 million valuation in the online market world, something you're a little bit more comfortable with. So with that in mind, a 4-week prep campaign, 3, 4, 5 month live fundraise, sometimes quicker is the timeline you're looking at if you're looking to raise a couple of $1 million in the space. And the benefits of doing that are what I just mentioned. You're keeping governance control and are not diluting yourself as a founder, and are allowing your users to become investors and just deepening your connection with your community.
And what should you be doing while the campaign is running? After it's launched, what should you be focusing on?
Well, there's two different things. As the founder, you also have to run the company, right? So keep in mind that 20 to 30% of all of your time will be devoted to this live fundraise, which, think about it this way, you're fundraising. You're going to have to devote time to fundraising, right? So that's a given, right? The chips are already on the table. You have to commit some hours a week to live fundraising, whether if it's chasing down VCs, angel syndicates, high net worths, setting up meetings with them, pitching to them, convincing them it's a good idea. It's a lot of work going down that rabbit hole. Definitely worth it if you have the connections and the ability to stay consistent, or get up a campaign page and be a little bit more strategic on your early stage fundraising, which is what I lean on. The way that I say, and I'm prefacing a lot of these answers because these are multi-layered answers here. While your campaign is live, you have to be focused on driving qualified traffic to the campaign page, which takes the form of reaching out to VCs, right? So if you're going to spend 10 hours a week reaching out to high net worths, VCs, and angel syndicates to invest and giving them a pitch deck and a pitch and term sheets and things like that, that is supplemented and exchanged by sending people your campaign page. Like, hey, check this out. If you're interested, for as low as $100, you can invest in my company. That's what a lot of your time is going to be spent on, is driving awareness around your campaign page. But that's very synergistic, because the way that I look at it is, if you raise $1 million through a Reg CF equity crowdfunding campaign, you can build a team, grow your ARR, and then when you go raise an A round with VCs, you have a much greater leverage to raise capital, because you've already secured capital and have the ability to negotiate on better terms. Randy just posted a quick question that I'll field those in real time. What do you see as the downside challenges with this model for SaaS in the B2B space? Really none. The only deviation is a lot of the B2C customers in the SaaS space end up becoming investors, but to a large degree, B2B SaaS companies are more sustainable revenue-wise, because you're getting larger LTV per customer that you're dealing with, and the scalability is much more predictable in the B2B space versus the B2C space. So Randy, it's all a matter of storytelling, right? How are you positioning your company? Do you have an existing user base in the B2B world that is relying on you? And sometimes reaching out to those shareholders that are already using your platform to invest is a great idea. So it's all a matter of storytelling, Randy, right? If you say, look, we have these 3 anchor B2B clients, we have 300K in ARR, that's as compelling as saying we have 10,000 B2C users as 300K in ARR, because those are scalable and replicable customers versus the B2C space that might have a lot of churn that the B2B doesn't have. Steve Shapiro just jumped in with another question. What about validated technology in pre-revenue stages? Great idea. Great question, actually, Steve. If you're in the pre-revenue stage, now we've raised millions of dollars for pre-revenue companies, but you have to keep in mind one thing. The investors will have a high level of skepticism in the pre-revenue stage, because there's a vast gap between validated pre-revenue to post-revenue scalable ARR. Light years away, quite frankly. The bridge that connects those two concepts, Steve, is going to be you. if you are an exited founder raising the next round, or let's say you are creating a engineering based platform that connects engineers, and you're an engineer yourself from a good academic background, great. The story needs to make sense. I am a Georgia Tech alum in mechanical engineering and coding, and now I'm creating a platform that is for coders in the mechanical engineering space. Like, I know this world, I have a degree in this world, I have friends in this world, I can bridge that gap. But like, if you're in the food and beverage industry and you launch engineering SaaS and you're pre-revenue, that's going to be a hard sell. So if you're bridging that pre-revenue gap to convince investors, it's going to rely on you, the founding team, and your background to bridge those two story points together.
And so what type of companies don't do well and why on crowdfunding? Where do you see the fall down?
Yeah, if you check any of these boxes, I would highly recommend not doing equity crowdfunding. One is, and it's actually all three. If you're pre-revenue, have no community, and by community, I mean immediate family, because your family is going to believe in you. They don't really care about the idea. They're going to put in a couple of $100, couple of $1,000. Your mom, your dad, your brother, your sister, your cousin, your neighbors, people, your best friends, the people you grew up with will chip in a couple of $100. That's your job as the founder to make sure they do that. If you don't have a large community that you can actually go after and convince, and you don't have that mindset as a founder, don't do equity crowdfunding. If you're radically pre-revenue without even the prototype built in the SaaS world or the physical product world, don't do equity crowdfunding. If you're just too early, don't do it. Or three, if you're in a world where your competitive differentiator or value proposition is not that high. Like, if I can buy what you're selling on Amazon, or if I can download what you're creating on the App Store with very little variation of what you're doing it at, it's not going to take off, right? So you have to have an innovative value proposition. You have to have a community. You have to have some type of attitude to chase people to sort of believe in your idea. If you don't have any of those, I would not consider this route. I would not consider any fundraising, and focus on proving out your model a little bit more.
And how many crowdfunding portals are out there to choose from, and how many are really active front runners?
Yeah, great question. There's many. I think there's like over 100 portals now in this world. I would primarily stick to republic.co and wefunder.com as the two biggest portals out there right now. They have the most traction. Republic just closed a $150 million Series B round, so that's a very big market validation statement for that platform. WeFunder is also scaling internally themselves. If I was a founder, I wouldn't deviate from those two platforms because they have the most traffic that they're getting. Because if your campaign is live and you're able to raise 100, 200K through friends and family and users, and you're listed on the homepage, you're going to get a lot of organic investors coming into your campaign because you're already listed on the popular section of those platforms. And there's a lot of other value adds, but outside of Republic and WeFunder, I wouldn't necessarily consider, for first-time fundraisers, any other platforms.
And how do you see angel groups, VCs playing with crowdfunders? Do you see them as two separate worlds, or do you see it as a continuum from one world to the next? And how do you see that playing out?
Great question. The tone has been changing. 4 years ago, VCs were like, what is this? Now they're like, okay, either we participate or we get eroded away eventually, right? So that's the mentality shift that I've seen. I've had conversations with senior directors at SoftBank that are launching multi-$100 million funds that are looking at equity crowdfunding as a viable source to either fulfill the rounds that they lead, or lead rounds and then they fulfill it. I've had conversations with multiple angel syndicates and VC groups that are looking at equity crowdfunding very positively. So the way that you position that is, if you have a VC, let's say you're raising $2 million. If you have a lead investor coming in for 250 or 500, you give that lead investor, through an institutional fund or a high net worth, a discounted valuation. Let's say you're raising 2 million at a $10 million valuation. So you could say, hey, for the first 500K, we're going to raise at an $8 million valuation and make it sweeter for the institutional investor to come in. And then for the other 1.5 million, launch an equity crowdfunding campaign to subscribe the other $1.5 million. So we've seen a lot of synergies between having an institutional or an angel syndicate lead the round and then subscribe the rest, or subscribe the whole round and say, hey, we only have 200K left. Do you want to come in with one check? So we've seen a lot of that go back and forth. I think Reagan just had a quick question. What are your thoughts on Net Capital? The reason why I ask is they've never had anyone not reach their goal like Refund Republic, and they had 0 failures. Net Capital is another great platform. I should have mentioned them in my earlier list. I know their founding team very well. They're a great platform. Like there's like 3 to 4. There's Republic, there's Refunder, there's Net Capital, there's Start Engine. I mean, there's like 4 or 5 big ones that I would recommend working with. But outside of that, I would not necessarily focus on too many platforms, but definitely Republic, Refunder, Net Capital, Start Engine are all good platforms to pick from.
Well, in the angel and VC world, many startups start off with a safe note or convertible note, and then they set the valuation later when they start working more closely with those investors. If you don't have that group, but you go straight to crowdfunding, how do you set the valuation in this model?
Great question. A lot of this is, the way that I approach the question is, look, there's industry standards, right? X multiple on EBITDA that is relatively generally understood and agreed upon in the venture space. Follow that model if you can get your hands on it. Like if you're a services company with an advertising technology platform, you're getting a 6 to 8x EBITDA. That's the world that we're in. So I know that multiple. I know many exits that have happened in this space. 6 to 8 to 10x EBITDA is a good valuation model in the advertising services media tech space. In B2C SaaS mobile app in the ed tech space, there's a different multiple on EBITDA. I would recommend doing some research in your industry on what are benchmarks that the venture space has already agreed to, and try to stick with that. And if you're pre-revenue, like as a rule of thumb, like if you're a pre-revenue company, don't value yourself at 50 million bucks, right? That's just not going to fly, right? Like be under that $10 million mark as a rule of thumb if you're pre-revenue. Generally accepted in the equity crowdfunding world that if you have some traction, a couple thousand beta users, a really good idea, and the founders have had experience in the industry, 5, 10, 15 million has been a good number that's been thrown around that people haven't like pushed back on too much. But if you're pre-revenue and you're like, I'm worth 100 million bucks, like, be real. The way that I look at it is, would you as the founder invest in your own company at your own valuation for $1,000, right? As a third party investor. So just be realistic. If you can't find comparable benchmarks online, be realistic and be fair to your investors. That's the way to look at it.
Great. Well, if anybody in the audience would like to post a little bit about their deal and if it should be a good fit or not, we can have Krishan weigh in on that. In the meantime, Krishan, can you tell us more about how you help crowdfunding campaigns at the Arora Project?
Yeah, definitely. So, we look at ourselves as the management consultants of this space, where we have hundreds of deals coming through our pipeline per month. We vet the deals. We have a very strict diligence process where we vet the deals. We look at the team first and foremost. We look at the revenue. We look at the value proposition of the company. We look at all the different variables. Once they make it through our filtration process, say for every 100 companies that apply, we select like 7 or 8 to work with. Because we're vetting very strongly who we end up partnering with. Once we've vetted those deals, we then start that 4-week prep process where we put them in touch with the platform, put them in touch with accounting firms, law firms. We have a whole creative team in-house that'll create all the assets for the page. We have access to over 100,000 investors on our own database. We have access to amazing partners like 10 Capital Network that have done great amount of work for all of our deals. So we soup to nuts do the whole fundraise from 4 weeks before launch to 2 weeks after launch, and the entire fundraise in the middle, running the ads, acquiring the investors, sending out the updates. So we're sort of A to Z shop on fundraising in the space.
Great. And so what should they do when they approach you? What should they be bringing in to say, here's what I want to do, so we have enough information to start having a meaningful discussion?
Yeah, so I just pasted our website in the links. Go there. There's a quick apply button on the bottom and on the header itself. Just fill out a quick form, and our head of sales, Elliot, will be in touch to set up a sales call, touch base with you on what we do, how we do it, vet out the process a little bit more, and if it makes sense, put you in touch with the right platform and start for the fundraising process right now.
Great. Well, we got a deal right there. Can you read through that and tell us
Yeah,
what you
sure.
think?
B2B SaaS security and compliance for healthcare HIPAA, currently raising 2 million seed through a convertible note, 6% interest, 20% discount, 8 million cap, 50 clients on the platform. That's that's a great company, man. You're probably going to close the year at $1 million year to date, 25% net revenue. If I read that 248K as your net revenue, that's incredible. I think, Randy, definitely please do go to our website and just submit a quick form on contact information, website, your pitch deck, things like that. And then our team will be in touch. That's like the ideal stage of companies we're looking at. Like, you're not at the concept stage, you're over $1 million a year, or your projections for next year should definitely be aggressive. Double your sales projections for next year, because you have to incorporate some type of growth path. If you're doing $1 million this year, 2 to 3 million next year, a 25 to 30% EBITDA margin, and you're in the B2B SaaS space, I think you have a really good shot at raising a decent amount of capital. The only thing I'd say, Randy, is similar to the institutional fundraising space, finding a lead investor is key. Right? Finding that lead investor, whether if it's through your existing community members, friends and family, or 1 or 2 or 3 people coming in for 10 to 15% of your round, that's a very strong market indicator to the other investors, because you have to think about the psychology here. You're putting up an online fundraising space. Most of these investors, Randy, will have never heard of you or your company. And if they come on your campaign page and see $250,000, $300,000 already raised on a $2 million round, that's a very strong signal that you sent to the market that other investors believe in your idea. So these quote unquote cold investors who haven't heard of you will feel a lot more secure investing in you versus going live at $0 fundraise. So as long as those numbers check out and you can find a lead investor, we're more than happy to raise a round for you. I think Cher just jumped in as well. B2B SaaS, financial operations integration, strategic partnership with SAP, interested in raising 1 million and $8 million valuation. Both of you, Cher and Randy, definitely please go to our website. Here, let me just even type in our head of sales email. Just directly email him after you submit the form. He'll be in touch with you after. Tell him you were on a webinar with us. Both of those are good candidates at first glance for an equity, and definitely partnering with Hall and his team would make a great partner, because we do that anyway for many of our campaigns. So putting together the whole infrastructure, the platform partnerships, the content creation, the investor acquisition, partnering with Hall and his team, and getting the job done. Randy and Sharon, I'd highly recommend moving forth with that.
Great. If there's anybody else in the room that wants to post, we have a few more minutes here. And while we do that, Krishan, can you talk about a recent deal that has raised funding that you'd like to share with the group? Any success stories that have come up in the last month or so?
Yeah, one of the ones that we're raising for right now is a deal called Up Council. They're actually on WeFunder. Incredible company. I think we're already raised a little over $2.5 million for them. That's just a slam dunk of an idea for us. If you go to our website, we have over 75 live offerings right now. All of them are great offerings backed by great founders. But Up Council is definitely one to keep an eye on. They've raised a lot of money through our system, and are a great team with a great founder.
Great. And you talked about some of the changes that came up in the crowdfunding world, raising to 5 million. What do you think will happen in the next 12 months that might be of note or worthy here for the crowdfunding world? Any regulatory or other changes you see coming up?
Yeah, I can't speak on the regulatory updates, because that's a whole political ecosystem in itself. But in regards to what I see happening in the venture space, Hall, is a lot of institutional funds, angel syndicates, and high net worths and family offices, as I'm sure you're even aware of now, are looking at the space much more seriously as a sidecar vehicle or a complementary vehicle to their existing fundraising or capital deployment needs, where if an angel syndicate or a venture firm is going to invest $5 million into a company, they can invest 3 and subscribe the other 2 with a Reg CF campaign where they're not giving up board seats at a higher valuation than their round. So it's just, we're seeing a lot of creative workarounds and a lot of creative integrations with the equity crowdfunding world from the institutional world as well. And I believe there's going to be some new favorable regulations coming over the next 2-3 years that are going to make this world even better. So I'm seeing a lot of mainstream adoption from the powers that be of this space as well.
Great. Do you see any positives or negatives to running, say, a crowdfunding campaign at the same time you're running a Reg D accredited investor campaign? Any pluses or minuses to that approach?
Great question. I mean, I wouldn't want to dilute, but to think about it this way: if you have a Reg CF live on Republic or Net Capital, and then a Reg D on your own private placement memorandums that you're giving out, I would rather you take those Reg D investors, put them on the Reg CF campaign. We legally will put them in the Reg D, so you can continue to raise on the Reg CF. But the reason why we do that is social proof. The more capital you have on the campaign page, that fundraising number, the higher that is, the more capital you will raise because of the perception of momentum. It's very important, right? So if you're raising 500K in a Reg D and 100K in a Reg CF, I would rather you raise 600K in a Reg CF. So on the back end, we can move those 500K on a Reg D, so you can still continue to raise the full $1,070,000 on the Reg CF. And the reason why we do it is the new investors that come to your campaign page will see the 600K number as a public-facing number, and that's very important to generate momentum and keep the snowball moving.
Well, some VCs and angels have heartburn over the crowdfunding campaign because there's fees charged on it. And VCs have rules in their operating thesis, and angel groups have rules in their bylaws against paying fees like that. How do you manage that process?
That's a great question. Some platforms that I know don't take any fees of check sizes over 25,000. Some platforms are willing to make exceptions on fees. So it's a conversation you need to have with the platform that you're leveraging to see if they're willing to make some exceptions for you. But if not, this is the pushback that I would give to that is, look, if the VC comes in and deploys 250, you can definitely go to the platform and say, hey, look, the only way this fund will invest is if you don't take any fees off of it. Some of the platforms might say yes, some might say no. That's a conversation that you should, as a founder, should have with the platform. But for all the other investors that come in, because the platforms are doing the KYCs, the AMLs, and all the back-end security check, background check work, they need to take that fee, and it's worth it in the long road for me.
Great. Well, you put up your contact details. Can you tell us a little bit more about your group? What exactly do you do in one of the campaigns? What's kind of the steps you go through in getting people ready?
Yeah. So, at the Arora Project, we really have a 3-step process. It's because of the 3 Ps: prep, private, and public. So in the prep phase, as I mentioned, once you enter our ecosystem, we'll put you in touch with the right platform, whether it's Republic or Net Capital or WeFunder. We'll put you in touch with the right platform based on what we believe will be the best platform for you. Because we've run so many campaigns and so many platforms, we sort of understand the ecosystem pretty well. Once we place you with the platform team will start the Form C filing, the audited financials or the reviewed financials, and sort of the compliance diligence work, which is required to file with the SEC and FINRA before you can do the securities fundraising. And then my team will come in and get the page ready, get the video ready, get all the assets ready, queue up our investor network, queue up partners like U-Haul, queue up a whole investor acquisition funnel. I mean, it's a pretty robust exercise we go down during the private and the public phase. So over the course of, if you work with us, under 12 weeks is sort of what we aim for to raise a multi-million-dollar round from soup to nuts. And you as the founder can continue to focus on running the business and allow us to manage the entire fundraising process.
Great. Do you work on decks and videos and that type of thing, or do they have to bring it?
The whole 9 yards. I mean, we have a full creative team in-house that can create everything for you. Every piece of content across every channel will be created for you from one creative team. So it's all succinct and uniform across the entire ecosystem.
Have you found the decks to be different between the crowdfunding world and the angel world, or are they pretty much the same?
Pretty much the same. Now, in the angel world, you might want to get a little bit more specific on, your CACs, which is your customer acquisition costs, your LTVs, your lifetime values, your CAGRs, compounded annual growth rate. Some of these nomenclatures and the ratios and the mathematical analyses that the venture world looks for and are accustomed to, some of the retail investors might not know what those percentages mean and might not get that, like your TAM growth rates and things like that. But having one unified pitch deck that summarizes everything, the way that I angel invest is if I bring in my 9-year-old nephew and if he can't understand what you're saying, I'm not going to invest in the company, right? That's sort of my philosophy. So have one deck as simple as possible in the most layman's term nomenclature as possible. Like, this is who we are. This is what we do. This is our revenue. This is how fast we're growing. This is the market. This is where we want to go. You can have 5 slides, quite frankly, in size 12, Times New Roman, white background, black font with no images, right? The presentation does not matter as long as the substance is there. You could have 3 bullet points on each slide, 5 slides in black font with white background. As long as the substance is very appealing, that's what matters. Now, we obviously take a different approach and we incorporate design with substance, which is the ideal world where you want to be. But one pitch deck should be fine for your fundraising needs.
And what do people use for videos? Are they explaining the problem, or are they showing the demo, or what exactly do they do with it, or what should they be doing with it?
Yeah, great question. We've created hundreds of videos for hundreds of fundraisers, and we've seen the drop-off rate, which means more than 75% of people stop watching the video past 34 seconds. So we work with issuers all the time. We're like, look, if the first 30 seconds of your video is like stock footage of people getting excited and all this glaring music and fireworks, like, you've lost 8 out of 10 people. Like, if you're going to create the video for yourself and you don't have the budget to work with us or spend a couple $1,000s to create a video, get in front of your webcam, get some B-roll footage, download some stock music, and just talk about your company. Hey, my name is Krishan, and I'm creating the best mouse that's ever existed. The reason why I believe this mouse is going to work is because of our technology, our team, and our market. And you just talk about what you're doing, right? So you can, in the first minute or less, you have to address who you are, the problem you're solving, why it's important that you raise money, and some of the key metrics around the business, right? And keep it very simple. If you can work with a team like ours, I mean, we'll do a full production suite for you with, Super Bowl commercial quality stuff, but the strategy does not change. In the first 30 seconds to 60 seconds, you have to address the problem you're solving, the team that's solving it, and the metrics around the business.
Great. And so how long should somebody consider running a campaign? Is it always 6 months? Is it shorter, or could it be longer? What are the rules there?
I think it's 12 months is sort of the cap. You can raise up to 5 million or 1 million or 5 million, depending on which regulation you fall under, in a 12-month calendar period, 12-month calendar year. But, if you have existing users that you can kind of just tap into, we could raise it much, much, much faster. So these are all very customized variables per issuer.
If you set a goal for, say, $1 million, can you change it as you go, or are you stuck at $1 million?
Yeah, this is different from the Kickstarter world, where you don't necessarily set a goal for those, some of these issuers. There's the minimum and the maximum of the round. If you make any changes to the minimum or the maximum of the round, those are material amendments that require all existing investors to reconfirm their investments. Not recommended going down that route. You'll lose a lot of investors. So create a valuation, create a minimum, create a maximum, and stick to it, and get the job done.
So when you finish that campaign, can you turn around and start another one, or do you have to wait a certain amount of time?
I would highly recommend taking that capital, deploying the capital you raised, having a story. Hey, when we first fundraised, we were at step 1, raised $500,000. Now, 6 months later, we're on step 3. We hired 5 new people. We landed 3 new big B2B clients, or got 10,000 new B2C customers. And now we're raising a second round because we need this capital for getting to step 5, right? So do not raise back to back without showing you've done something with that money, and you've proven out that you can actually execute on fundraising rounds.
Great. Well, if anybody has any questions, go ahead and put them in the chat box as we do some closings here. We're not seeing your contact details for your sales director. Can you post that again, please? I think that was Elliot.
Yep.
So we'll put that in there for you, Randy. If anybody else has any questions you want before we wrap up, we will be reaching back out to everybody that joined today and see what we can do to help you. We will provide that with Arora, so they can also reach out with you as well. So anybody has questions, I think there will be plenty of contacting afterwards. But if you have any more questions about crowdfunding, love to help you guys with it. And by all means, reach out to 10 Capital, and we'll be putting on more sessions like this on a regular basis. And looking at real projects and talking about how you structure them, how you set them up, what you should do. I find positioning of the deal is a key element of crowdfunding. It needs to show off very well. Someone needs to look at this on the screen and get what you're doing very quickly, in a third of a second or less. And because they're not going to dig in to see what it is, it's got to attract them into it. And so how you position it, how you promote it is very important. The visuals are everything. And so that's why it takes some time to put all that together. So with that, Krishan, can you give us some final words of wisdom here on crowdfunding?
Yeah, I'll take Judith's question and then I'll give some concluding thoughts. Is a pre-revenue company too early for this? No, it's not, for two reasons, Judith. We've raised money for pre-revenue companies under two circumstances. One, the idea is just radically innovative and you've already created the software prototype or the physical prototype. You're like, hey, we're creating this incredible product that does not exist. We've already created a couple of them and have a couple of hundred, a couple of thousand beta testers. The story is very compelling. Like, let's say, you want to bring back the woolly mammoth with a couple of, colleagues through a network of mine are trying to do, or like you create some radically innovative blockchain company or a social media platform or some really interesting mobile app or a web app or a physical product. If you're pre-revenue and the value proposition just gets people, it makes sense. Or two, if you're pre-revenue and you're an exited founder who has a track record of building and selling companies and raising capital and delivering a return to investors, like either one of those, we will work with a pre-revenue company. But if this is your first rodeo in the startup space and first business, the value proposition you may believe to be radically innovative, but to a general pool of people, it's like, hey, this is cool, but it's not going to like revolutionize the world. And you don't have a crazy track record of delivering ROIs to investors, then pre-revenue might be too early for the space. And then number four is, ignoring all of those, if you just have the tenacity to chase down friends and family, and if you have a large network of people that believe in you, then pre-revenue is fine. So it's either you as the founder are in a pre-revenue business, but have a stellar track record of building and selling companies. That's one way we work pre-revenue companies. Two is you as a founder started a pre-revenue business or are in a pre-revenue stage, but the value proposition is just like, whoa, like you have SAP and Google like having conversations with you, even though they're not contracts, you're having conversations with them because of what you created as value is so high. Pre-revenue is fine, you can do it in that realm. Or three, you as a founder are just a bull and you're like, you know what, I need to raise 250,000. I will get 25 people to give me, $10,000 each, or I will get 250 people to give me $1,000 each. Here's my Excel sheet of 250 people, and I'm not going to sleep until these 250 people give me $1,000 each. Then you can raise the company in a pre-revenue stage. Outside of those three, I would not recommend not only equity crowdfunding. I just wouldn't recommend fundraising. Period. If you're not part of those three buckets. Great.
Well, thanks for that advice. And then, what's your closing wisdom for the group here to wrap us up today?
From the caliber of the founders that are in this webinar, I would highly recommend all of you to check our website out, check our 10 Capital Network, and look towards fundraising. And if you have a community of people that believe in you, highly recommended to launch a Reg CF campaign partnered with us at 10 Capital, and looking forward to hearing from you all.
Krishan, thanks for joining us today. Thanks for all the advice and wisdom there. For those in the audience, I want to thank you guys for spending your time with us here. We'll be back out to talk with you later about your interest in crowdfunding and fundraising in general. And with that, we'll go ahead and close it out. Thank you guys for coming, and we'll be back next week with more. Have a good one.
Looking forward to it. Thank you, everybody.
Thanks.